Inventory cover or stock cover represents a period of time how long a retail unit is able to continue to sell items based on current inventory. To put it in another way, it indicates how many weeks or months of sales a retailer can cover with the current stock. It is usually represented in weeks or months. It's also known as weeks coverage or months coverage, forward coverage, stock cover, or weeks on hand or month on hand. Inventory cover is usually represented in two forms: spot cover and forward cover. Spot cover indicates how long current inventory on hand will last given the current rate of sales. Forward cover indicates how long the current inventory on hand will last given the forecasted rate of sales. The difference here is related to which sales do we use as the denominator. Let's show this with an example. Spot cover is calculated by dividing current stock by current sales. That means the sales you just achieved is divided by the current stock. Forward cover is calculated by dividing the current stock by forward sales. That means not the sales that was achieved in the current period, but the sales you are going to achieve in the future period. Whereas spot cover looks at today, forward cover looks at the future. Like many other KPIs in inventory management, this can be calculated at sales value or at cost. Stock is always taken as closing stock. Let's explain this with an example following from the example that we had used in the previous lecture. We will calculate the inventory cover for Acme Retail at the end of March. We have the information of the monthly sales and stock. Information till March is actuals. April onwards, it's a forecast. Now we calculate the spot cover. So we look at the current stock, which is 6,000 at the end of March, and divide that by the current sales, which is 4,000 for the month of March. That gives us a stock cover of 1.5 months, which means that with the 6,000 closing stock that I have, I can continue to sell for another 1.5 months till the time I run out of stock. When we do the same calculation for the forward cover, we get 1.14 months of stock cover, or less than 5 weeks. How did we get that? So again, we look at the stock which we have taken. It's still 6,000. So it's the same stock value we have taken for spot cover, but the denominator, which is the forward sales, now that looks different. And the forward cover over here, what we have taken is we have taken the average of the next 4 months, where we get 5,250. So not looking at what we have done so far, but we're looking into the forecast that we have built for the next 4 months. And when we do that calculation, it says that our stock cover is 1.14 months or 5 weeks. If you would have gone only just with the spot cover, we could have ended up with buying less for the future, as we feel that the stock is sufficient to cover us for an additional week. But this could happen to lead us to stock outs and losing shoppers. Therefore, the forward cover is a better KPI to follow than spot cover, because we always need to look at what is happening in the future, because that the stock we need is to support the future. What's happened in the past has already happened. We have achieved our numbers and that's done. But the next task that every inventory planner or a merchandiser has to look at is, I need to make sure that my future sales are protected. What is the importance or the reason that we use inventory cover? First reason is, of course, sales. The main goal of an inventory planner is to evaluate if the retailer has sufficient stock to cover the business requirements in the coming weeks or months. And inventory cover really helps us understand if that is going to be the case, as we saw in the previous example. The next one is financials. For small business in particular, knowing weeks of cover on hand can be valuable. With large chunks of capital tied up in inventory, this metric can provide a snapshot of overall business health. If the calculation reveals that a retailer is sitting on inventory with too many weeks of cover or too many months of cover, they can clearly not be managing their inventory as efficiently as possible, and potential investors or stakeholders may be discouraged by this information. Thirdly, it's an important tool for planning. Like so many things in business, the reasons weeks on hand matters to most businesses is because it shows them where they may be spending more money unnecessarily or losing money thanks to poor inventory management. That alone should be more than enough reason for a retailer to make sure that the weeks on hand number is appropriate. That is, it is on a spot where shoppers are happy and product is selling. If the stock coverage is too high, the retailer will end with excess inventory at the end of a season or a trading period. If the coverage is too low, the retailer will risk running out of stock before the season ends and thus losing business and sales. Lastly, it's an important KPI to support supply chain. Stock cover sends a signal to the supply chain to control the production and deliveries of product. If you have low stock cover, you need to produce more stock to support the sales. If you have got a high weeks of cover, that means there's too much stock in the business and you don't need to take a lot more, and therefore the supply chain needs to slow down their production as well to balance the stock level in the business. We saw in the previous lecture about the inventory turnover ratios. This KPI or metric is connected to the inventory cover or the stock cover ratios as well. Inventory turnover ratio is inversely related to months cover. Better the inventory turnover ratio, lesser the months of cover, and vice versa. So, as we said a bit earlier as well, was that most of these ratios are interconnected. Of course, the common denominator is inventory,